Hello, my name is Diego Saputra, NPM 244120111 from Accounting Study Program.
I will explain about monetary system. The monetary system in macroeconomics. The monetary system is a crucial pillar of a modern macroeconomy. It encompasses the institutions, frameworks, and policies that govern the creation, circulation, and management of money within a country. A well-functioning monetary system is essential for facilitating transactions, allocating resources efficiently, and maintaining macroeconomic stability. Understanding its components and mechanisms is vital for comprehending how economies operate and how monetary policy influences economic outcomes. Modern monetary systems primarily rely on fiat money, which has no intrinsic value but is declared legal tender by the government. Its acceptance is based on public trust and government decree. Historically, economies have also used commodity money, e.g., gold, silver, which has intrinsic value, and commodity-backed money, e.g., banknotes convertible to gold. The structure of a monetary system typically involves several key institutions. The central bank plays a pivotal role as the apex monetary authority. It is responsible for issuing currency, managing the nation's foreign exchange reserves, acting as a banker to commercial banks, and most importantly, formulating and implementing monetary policy. The central bank aims to achieve macroeconomic objectives such as price stability, controlling inflation, full employment, and sustainable economic growth through its policy actions. Commercial banks are another critical component, acting as financial intermediaries that accept deposits and provide loans. They play a significant role in the money creation process through fractional reserve banking. By lending out a portion of their deposits, banks increase the overall money supply in the economy. The money supply refers to the total amount of money in circulation within an economy at a given time. It is typically measured using various aggregates, such as M1, narrow money, including currency in circulation and checkable deposits, and M2, broad money, including M1 plus savings deposits, money market accounts, and other less liquid assets. The central bank employs various monetary policy tools to influence the money supply and credit conditions in the economy. These tools generally fall into three main categories. Open market operations, OMOs, involve the buying and selling of government securities by the central bank in the open market. Buying securities injects money into the banking system, increasing the money supply and lowering interest rates. Selling securities withdraws money, decreasing the money supply and raising interest rates. OMOs are the most frequently used and flexible monetary policy tool. The policy rate, or discount rate, is the interest rate at which commercial banks can borrow money directly from the central bank. A lower policy rate encourages banks to borrow more, increasing the money supply and potentially lowering lending rates throughout the economy. Conversely, a higher policy rate discourages borrowing and can lead to a contraction in the money supply and higher interest rates. Reserve requirements are the fraction of a bank's deposits that they are legally required to hold in reserve, either in their vault cash or on deposit at the central bank. Lowering reserve requirements frees up more funds for banks to lend, increasing the money supply. Raising reserve requirements reduces the amount of money banks can lend, thus decreasing the money supply. This tool is less frequently used as it can have a significant and abrupt impact on the banking system. The effectiveness of monetary policy in influencing the economy depends on various factors, including the responsiveness of banks and borrowers to changes in interest rates and the overall economic climate. Monetary policy operates with a time lag, meaning that the full effects of policy actions may not be felt for several months. In conclusion, the monetary system is a complex but essential framework that underpins economic activity. The central bank, commercial banks, and the mechanisms of money creation and monetary policy are integral to its functioning. A stable and well-managed monetary system is crucial for achieving macroeconomic stability, fostering economic growth, and ensuring the smooth functioning of markets. Understanding the intricacies of the monetary system is therefore paramount for anyone seeking to grasp the workings of modern macroeconomics.